So time is ticking. There's 10 days left before this program ends, which is very important, a funding program that is utilized by the banks out there in the US. Now, before I get into it, my name is Daniel. Welcome to InfoVest. If you're new to the channel, check it out. Check out the videos. We've got a lot of videos on macroeconomics, on markets, on news, etc., etc. Feel free to hit the subscribe button, the like button, the bell icon to be notified on the next video. Comment below on what you think about this video and also future content or ideas that you may want to hear about. Now, let's get into it. I'm pulling out an old article that came out on January 25th of this year. It comes out from Reuters. It's titled, Fed to Allow Emergency Bank Lending Program to Expire on March 11th. Okay, so we've got 10 days left before this program ends on March 11th. Now, starting with the first paragraph here, it says the Federal Reserve on Wednesday said a funding lifeline created for banks last year after the collapse of Silicon Valley Bank threatened to spark a wider financial crisis would close as scheduled in March. The Fed also came out and posted on their website that this funding program is coming due and it's going to end very soon. So it's also confirmed from the Federal Reserve. The Fed also raised its interest rates on new loans from this new funding program. What is this funding program I'm talking about? It's called the BTFP, which stands for the Bank Term Funding Program. So this BTFP is a program that helped a lot of the banks, especially Silicon Valley Bank, that were threatened last year with it going under and its operations being in trouble. And it was this kind of liquidity program where it injected cash or gave loans to the banks so that they could, not close and create panic in the economy and in the markets. Now this program, this money, these loans, the BTFP, is coming due in 10 days. Now moving on in this article, it says here the BTFP for the remainder of its life, effectively ending what had become a popular and profitable arbitrage opportunity for U.S. lenders, which analysts said should deter fresh borrowing. So the BTFP not only allowed banks to take loans and seize the opportunities by taking fresh liquidity and fresh money, but it was also utilized to create arbitrage strategies and opportunities so banks could make more profit. Very interesting. What am I talking about here? Well, let's get into the article further and I'll explain later on. The sunsetting of the program on March 11th, so that's the date that it ends, had been signaled by the Fed officials as fear in the banking system abated. The BTFP was really designed in emergency situation, says Michael Barr, which is a Fed's vice chair for supervision. He said, referring to the banking sector panic triggered by SVB's rapid collapse, it was designed for that emergency to say, we want to make sure that banks and creditors of banks and depositors in banks understand that banks have liquidity they need. So they were trying to slow the blow and not have this issue in the banking system cascade and get even bigger. Now, moving on, the Fed launched the BTFP amid a historic run on deposits and other market stresses after Silicon Valley Bank and Signature Bank failed in lightning fast fashion, tapping emergency lending powers the central bank can roll out with the approved of the Treasury Secretary under unusual circumstances. While the Fed said it would continue making new loans until the program concluded, it said that it said that as of Thursday, it was raising raising the interest rate banks would pay for any new Fed lending. The Fed said the interest rate on new loans would be no lower than interest rate on reserve balances on the day of the loan. The end result is nearly 50 basis point jump in new borrowing costs. The BTFP loan rate was 4.93% on Tuesday, while the reserve balances currently reach 5.4%. Now here's the thing, right? Going back to what I was saying. So this BTFP not only opened the doors for banks to take loans and fresh liquidity, but people and banks were taking this opportunity to create this arbitrage strategy where they were getting this BTFP loans at a lower discount rate and then investing that money, parking that money in reserves that basically at the Fed that was giving them a higher interest rate. So they were borrowing money at, let's say, 4.9%, and they were taking that money, putting it at the Fed to earn a return of around 5.4%, right? Plus 5%, let's say. So they were earning a positive return, even though they were paying back, let's say 4.9, they were earning 5.4, so they were net positive. Even if they didn't need the money, they probably took that opportunity to make an additional profit for themselves. And it was an easy scheme for the banks out there. But again, this is all coming due and it's coming end, this program. There won't be any more BTFP unless things change, but there won't be any BTFP as it ends March 11th in 10 days. So this is really important because when you look at the recession, when you look at how everyone's been talking about recession in the past 2 years, that a recession's coming, and it hasn't, right? Although I know you may argue otherwise, but let's just focus on the textbook definition that we haven't received. We haven't seen the recession and haven't seen the true colors of the job losses yet, right? And it's been quite some time. You can argue that part of that had to do with, yes, the amount of money printing that was done, the stimulus that was injected from the fiscal side of the government that prolonged this growth that you might be seeing. And again, I put it growth, right, in quotations. And also on top of that, when you got the Silicon Valley Bank last year and other banks out there going under, you had the Fed coming out to rescue and injecting more liquidity in the system again through the BTFP, again prolonging, pushing, kicking the can further down the road, kicking the can further down, that, hey, you know, this recession looks like it's not coming. Well, it doesn't look like it's coming because you keep getting this injection of liquidity, and you got the BTFP that's running in the background that's been keeping things afloat, keeping the banking sector fine. But tell me one thing, in 10 days when this program ends, do you suspect that something might creep up again, something might pop up again, especially if liquidity tightens and the banks cannot use the arbitrage opportunity to make profits? They can't, take out this fresh liquidity in loans and cash and sit on it. When that tightens up, what are they going to do when it comes to lending to the consumers or to businesses in the real economy? That's also going to tighten up. And as things start to tighten up further and further, it's a trickle effect. Not only businesses get affected, there's less need for less demand. Layoffs start to happen, contractions start to happen. Maybe some banks, regional banks, like we've been talking about on this channel, the commercial real estate, a lot of them that are coming due, they take heavy losses on that. And again, you get the same scenario like last year where a bank blows up or goes under like Silicon Valley Bank, and we get further deterioration in the banking sector. So I'm not saying March 11th is the day where everything's going to explode and everything's going to get worse. I'm saying from that day onwards, things are going to start to tighten further, which poses a risk in the banking sector, in the economy, in growth, in the markets, that things could pop up, could get worse again. We could see another scenario, another situation where a bank gets in trouble and it starts to cascade further and further. And with the Fed not cutting rates in March, pushing it away, saying June, July, saying that we're going to get maybe 3 rate cuts this year, right? And that they are data dependent. They keep pushing away the idea of rate cuts. As that continues, then you can expect that, yes, this will start to tighten markets further because you're not getting that easing as quickly. Now, not to say that this program can't come back in again, but again, it will come in if there's a issue that spawns up, or something that breaks, or something that explodes, or a situation that happens that causes the Fed to step in. And when that situation happens, then yes, you can expect that, hey, maybe things may not be that good, which is why the Fed needs to step in and do something about it. Hence the rate cuts, hence lending and so on, right? So many things that could happen. We'll see what will happen when the time comes, and it's very likely, according to history, that the Fed is always late to the party, and when something finally breaks is when they really ramp up those rate cuts and start to ease further and further. But until then, March 11th, BTFP is done, and then we will see where the ticking time bomb is and what is the first one to go and blow. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers, bye.